which will be given by Peter Christie, who's MD and Chairman, and Mark Middleton is also CTO, who's also here to answer any questions that you may have. So, Peter, over to you. Thank you.
All right, great. Thanks, Alan. We will try and get through the slides as quickly as we can. Obviously, beginning with the usual disclaimer. But let's start here with personnel. As people that have been following the story at ActivePort, we realise that we've had a few executive changes in the last 2 quarters. At the moment, I'm the acting CEO, and between myself and Mark, we are running the business following Kairam's departure back in April. We'll keep that in place in the short term and then look for a full-time CEO somewhere in the next 2 quarters. You'll also notice Joseph, our new CFO. Joseph started with us this month and is busily working on the audit and the annual report. Everybody else are the same faces that you would have seen before. And of course, on the call with me today, we've got Mark Middleton, our CTO and the founder of the business. So a quick introduction to ActivePort for people that are new to the business. ActivePort is a software company. We build a product that automates the delivery of network connections between people's branch offices and the cloud. We typically sell the software first and foremost to telecommunications companies. By that, I mean Telstra, Telekom Malaysia, RTE, any telco in the world that has a large network is typically a customer or prospective customer of ActivePort's. And then those customers use our product to deliver automated services through to their end users. And like any software company, our real objective here is to generate high gross margins. Software companies traditionally can deliver 80 to 90% gross margins because it is software. And so that is our goal in the short term, is to become a traditional software company delivering high gross margins and good free cash flow for the investors. Why do people look for our software? Well, the telecommunications market is changing. Telcos need to automate. I think you see it with the success of products like Megaport, which make it very easy to make global network connections around the world. All telcos realize that they need to be able to deliver that sort of capability to their users. And ActivePort is a software product that allows them to deliver that. If you look at our target addressable market, at the moment, we are focused on selling software direct to the telco sector. And in that sector, there are 3 areas of orchestration that we focus on. So if you look on the left there is what we call edge orchestration. Edge orchestration are products that you would hear in the market like SD-WAN, VPN, NFV or network function virtualization. These are products that are used in the branch office to connect into the cloud. In the middle there, you can see core orchestration. Core orchestration and network-to-network integration is the primary focus for a telco where they're trying to automate the core services that they deliver to their customers. And that's where we're generating most of our revenue from at the moment. Most of the revenue we generated in software in FY23 is in that core orchestration section. Then to the right, cloud orchestration. Cloud orchestration for us is orchestrating GPUs and servers in the network to run applications like cloud gaming, video on demand, and more recently, AI has become quite a driver of revenue in the cloud orchestration sector. So at the moment, we generate revenue from these 3 realms of orchestration. And if you look at our revenue for this year, which we'll get to in a little bit, but it's around about $9 million of software-related revenue. Most of that came from core orchestration and cloud orchestration. And we're just starting to see revenue flow from edge orchestration at volume. And so in FY24, we should be delivering revenue across all 3 of these areas. But what we have done in the last year and a half is deployed our software to 24 different telco customers around the world. We have a contracted targeted install base of 65 telcos, but we've only really activated 1 of those telcos to date. And so you can see that we have quite a large addressable market, and we've only just started on the journey of monetizing that market. Now, if we try and put some hard numbers on that, if each telco that we deliver core orchestration to delivers a total revenue over a reasonably short period of time, 3 to 5 years, of $3 million. Then our 65 telcos gives us a target addressable market in that central core orchestration column of $195 million. We think the cloud orchestration segment is potentially double that. And so our 65 addressable telcos at the moment equates to around $390 million of addressable revenue. Edge orchestration is a huge market. We think conservatively there's 8 times the revenue at the edge as there is in the core. And again, across just the 65 telcos that we're aiming to deploy in the next 12 months, we have an addressable market of $1.5 billion in that segment. And so you can see that we've been highly successful in core orchestration. We're branching out into cloud orchestration. We're working very hard at the moment to deliver revenue in the edge orchestration piece. Now, to put those 65 telcos in context, there are approximately 720 telcos in the world. So just the 65 that we're dealing with today is really just scratching the surface for us. People ask us about the competitive landscape, and if you separate the market into core orchestration, including cloud, and then edge orchestration, in core orchestration, the primary competition that we find is a product called Blue Planet from Ciena. There are a lot of orchestration products from other hardware manufacturers like Cisco, Juniper, Nokia, Huawei. What we find, though, is that they typically focus just on orchestrating their own hardware, whereas ActivePort is a hardware agnostic product. We also find that ActivePort's orchestration capability is more suited to customer-facing applications, so delivering an interface to a telco's customer that allows the customer to self-service products, whereas products like Blue Planet and some of the other orchestration tools from hardware manufacturers are more focused on internal-facing customer network operations users. Now, the interesting thing about Blue Planet, it was bought by Ciena. Ciena is a hardware manufacturer. It was bought by Ciena in 2018 for $463 million, which at the time was around 5 times revenue, which I thought was an interesting point to note around valuation of this type of software product. On the right-hand side with edge orchestration, that's a large market. There are hundreds, well, potentially not hundreds, but certainly dozens of competitors in the SD-WAN and VPN space. The ones that we come across a lot, Fortinet, Meraki from Cisco, Versa Networks, but there is a long list of customers in edge orchestration. But it's a much bigger market for us than just core and cloud orchestration. And so as we delve into that market, we've got some strategies that make us highly competitive. And I think we'll be able to have a good chance of carving out a niche for ourselves in the edge orchestration space. Speaking of niches, the one thing that we did deliver this last month is our Global Edge portal. Global Edge is all about offering a retail place for customers to register, log in, and access the ActivePort product. Global Edge allows customers to connect from the edge through to the cloud, and they can do that using they can connect from edge to cloud using our built-in SD-WAN and VPN capability, and then they can make connections from one data center to another or data center to a cloud service using our Fabric partners. Now, Fabric partners include Console Connect, which has recently been bought by Infratil, Megaport, which most people know, also Equinix's Fabric, and soon to be the Axon Fabric from NextDC as well. And when we talk about our transit ecosystem partners, a differentiator between, say, ActivePort and Megaport or ActivePort and Console Connect is that we don't build networks. We provide a software product that allows people to access other networks. And those customers can either access the transit ecosystem partners you see there on the left. If you're a telco and you've installed ActivePort on premise, then you can bond your existing network to an ecosystem partner network through our NNI capability with your own instance of ActivePort. But if you're a retail customer that just wants to access our network as a service product, Global Edge, you can also get access to those transit ecosystem partners through the Global Edge portal. And so with that positioning done, then the question is, how have we been doing in the last 12 months? And I must say that I'm quite excited about the results. The business is operating in three distinct revenue streams: ActivePort software on the left, the Global Edge network as a service, which we've recently deployed, and the managed services business on the right-hand side, which is our traditional MSP solutions from the Starboard IT and BizTime. The most exciting thing for myself and Mark is the software result on the left-hand side. We went into the IPO with around $370,000 of software revenue. We delivered $1.1 million of software revenue in FY22, but in FY23, that's escalated 600% to $8.28 million, which is an outstanding result. If I look at the prospects we had in our sales pipeline heading into FY23, it was a fraction of what we have at the moment. And so our challenge today isn't finding opportunity. We have ample opportunity in front of us. What we need to do is scale the business to make $8 million, 16, 24, 60, $100 million. We have a significant opportunity to generate revenue quickly in the software space. Global Edge, the foundation of Global Edge is our future broadband ISP in Australia. We purchased Future Broadband to give us the capability we need to automate a network as a service. That business is going very, very well with 23% growth, around 2,200 network endpoints. We should see that revenue number tick up substantially as we begin to promote our Global Edge network as a service platform. And then on the right-hand side, the managed services business. The managed services business has been stable. We are looking to integrate those businesses deeper into the existing, into the software and Global Edge business in FY24 as we deliver more domestic customers. And so we should see that revenue number increase and the margins increase in managed services as well in the next 12 months. And if we dig a little bit deeper into this, this is a half-year breakdown of the software growth. You can see that each 6 months we've been steadily growing the revenue in the software business. What is most pleasing for myself is that green number in the top table, bottom right corner of 2.93 million. The software business is profitable. If you skip down to the bottom right table, you can see the gross margin is only 64% at the moment. We project that will head up into the 80s very quickly as we add more customers and more revenue to the software business. Interestingly enough, our enterprise revenue per customer for FY23 is around 2.9 million. We expect that to stabilize at that level, and we have, as I say, 65 potential customers that are currently looking to install our software that we need to monetize as quickly as we can. In the Global Edge networks as a service space, typical ISP revenue per customer is around $40,000 a year, and we expect the volume of customers in the network as a service to be substantial. So we have two streams of revenue that we think will grow significantly in FY24. Our headcount is quite low. People wonder what it takes to run a software business growing at this pace. Well, we're doing it with 19 staff. I think we need to at least double that in the short term to take advantage of the opportunities that are in front of us. And so Mark and the team are working on plans to scale out the business so that we can take advantage of those 65 telcos that we have prepared to install. We've physically installed 27 locations for telcos around the world. And as I said before, we've converted one of those into a live deployment in the last 12 months, and we have a substantial pipeline of projects we're working on to get live at the moment. And so that one should turn to 5 very quickly, and then 10 and 20 after that. We have another 38 telcos behind those 27 pending installation. Some of those projects are significant. We are talking about installing ActivePort in some of the largest telcos in the world. To put it in context, some of our customers have more than 200 up to 450 million subscribers on their networks. 450 million compared to, say, Telstra with 25 million. You can understand the scale of some of the projects that we're working on at the moment, and hence the need for us to scale the resources in this business as quickly as we possibly can. Global Edge. It's new. We launched Global Edge in June. Mark has a plan for rolling out new features in Global Edge every 6 weeks. We are already integrated with the Console Connect fabric. We are working to integrate Megaport. We have done the bulk of the work behind Equinix, and we've started with Axon. And so building in the ecosystem partners into our Global Edge network is critical for us and a primary focus. And then rolling out features of the Edge, SD-WAN, SD-VPN, NFV, SIEM for security, SASE for security, as a raft of features in the Global Edge space that we will roll out in the next 12 months. Interestingly enough, we don't need to build a network to run Global Edge, so the OpEx is relatively low. You can see in the bottom right-hand corner a table that shows the sort of products and the sorts of gross margins that we deliver in the Global Edge space, starting with SD-WAN license revenue, local loop network connections where we already have 2,112 customers, international network transit through our partners, Megaport, Console Connect, etc., cloud on-ramps to get to clouds like AWS and Azure, and then cloud services within those sectors. And so Global Edge can deliver revenue from a number of different features and services that customers can access through the self-service portal. And then if you look at the managed services business, a year-on-year basis, revenue's down. But if you look at the work we did in the first half to consolidate the resources and focus on profit, you can see that the EBITDA number is drifting higher towards profitability, and you can see the revenue is creeping up. And so there should be a substantial improvement in this business in the coming half. And so then we get to the consolidated number. In FY22, the bulk of the revenue came from the managed service business. In FY23, almost half of the revenue is coming from the software business and the network as a service business, and we think that proportion will grow substantially in the next year. Overall, the business is tracking well. You can see we had a net loss of $7.9 million in FY22. In FY23, that's down to $2.6 million. And if we add in other income, which is predominantly R&D claims, you can see that our cash, or at least our net profit and loss for the year, is almost break even, which for us is a welcome result. If you look over to the right-hand side, and I would say on those R&D claims, people ask me about R&D quite often. The scheme was designed to support companies like ActivePort that are innovating and building new technology in Australia. It's not core operating revenue, but we anticipate that will continue in FY24, and so we're quite happy to count that and make it part of our capital plan. If you look across to the right-hand side, we have substantial cash and debtors. We have some net liabilities and creditors, and so we have net cash and current assets of 4.3 million, which we feel is an adequate buffer for the business going to FY24, given the projects that we have in front of us. And then if I look at some of the innovative things we're working on at the moment, it's natural for our telco customers that are deploying ActivePort software on our ANV hardware and GPUs to look at that platform as an opportunity to deploy AI. And so Mark and the team are working very hard at the moment on expanding the capability of our cloud orchestration product set to encompass the AI ecosystem. We've done some significant work with a major telco around the Dolly large language model from Databricks. We've been testing and trialing these types of products on our edge servers that we already have deployed in telcos around the world. And so those 65 telcos that are currently looking to install our hardware with GPUs and the ActivePort software are naturally asking us to get engaged in their AI projects. And so we anticipate seeing an uptick in revenue on the cloud orchestration front from the current trend towards AI. And so the outlook for FY24, it's all about scale up for us. It's all about converting the sales we've made to revenue in the telco sector. It's about generating more recurring revenue, both from those telcos that we've put into production and also from our Global Edge network as a service. Increasing capacity So delivering or scaling up our technical capability to deliver more telcos in parallel. And we're looking to do that from some strategic acqui-hires, which is a very cost-effective and rapid way to get the expertise that we need, and also just strategic employment of new people for the Mark's technical team. GPU orchestration, as I just mentioned, is quite a focus for us with the current trend towards AI, driven by people's interest in ChatGPT and other large language models. And obviously higher margins. As we scale up the software business, we expect the gross profit to head up into the 80s. That gives us a great opportunity to generate free cash flow in FY24. And with that, Alan, questions? Alan, you're on mute.
Sorry, Peter. So well done again on that software revenue. It's good to see that it's finally getting traction and it's about conversion now. So we have a question from Matt Lambie. Can you speak more on your plans regarding the growth of your teams? Will you focus on local or remote talent, for example?
What was the last bit? Local
talent or remote or remote?
The answer to that is both. There are pockets around the world where writing network software is an art that's been in place for a long time. Places around Halifax, Boston, those parts of the world, there's a history of developing network software in those locations, and so we're looking very closely in those areas to strengthen our technical team. We currently have a technical team that spreads from Auckland through Sydney and Perth. We will continue to grow that group. Some roles, it's just about the talent. Other roles, it's about proximity to the rest of the team. And so we expect that we'll build that capability in all of those locations. From a customer implementation and pre-sales engineering focus, we do have a plan to expand into 3 operating regions. So that would be the Europe and Africa space, then the North America, South America, Canada time zone, and obviously where we already operate between Sydney and Perth. And so one of the things we do need to do in the next half is begin to locate expertise in areas where the guys can work a normal 8-hour day. At the moment, we do find that the team is working around the clock, which is fantastic, and really appreciate their efforts in doing that, but it's not sustainable. And so we do need to broaden our geographic reach.
Thanks, Peter.
Peter, it's Alex Sundich from Bridgestone Capital. Just the question I have is 18 months roughly since the IPO. Do you feel that the company is ahead of the schedule, behind the schedule? What's really changed, and where do you see the status of the company relative to where you thought you'd be at this point? And what can that's really the key issue for me.
Yeah, I think it's so far ahead of schedule, it's frightening, Alex. It is like a tiger by the tail. What we didn't know when we set out to grow the business 2 years ago is what we would find in terms of market acceptance for the product, because it is a new product. We didn't know what we'd find by way of competition, and whether the product we had would be competitive with the feature set that we had. Turns out that we exceeded our expectations on all fronts. The product is unique. The competition is very, very thin, and the telco industry has embraced it like nothing I've ever seen in 35 years of software sales. And so to have the number of large telcos with our product already installed on their network, and our challenge at the moment is having enough people to convert those telcos to revenue. is a fantastic problem to have. And in terms of so in terms of performance and outcome versus expectation, I can't speak for Mark, but I think it surprised us both pleasantly. And we've gone from 18 months ago, it's taken a long time to explain to customers what we do and why we were good at doing it. Now we have customers reaching out to us to actively seek the product and ask us when we can come and install it for them, which is fantastic. I think it's outstanding, the level of demand that we're seeing for the software at the moment.
Fantastic, thank you. Well done.
I guess a question for me also, Peter. Obviously, the latest investment from Infratel into Console Connect, which you have application for. I guess maybe you can sort of share your view and maybe the rationale behind Infratel's investment into Console Connect, and obviously what it means for ActivePort, and no doubt what they paid pretty much sort of underpins your value in a sense. So maybe share your thoughts on that, please.
Yeah, I got so many thoughts on that, Alan. I could talk for an hour, but I won't. Infratel, I think the first thing is to look at Megaport and look at the relative valuations. I think Infratel paid 5 times revenue. If you add the capital commitment, approximately 5 times trailing revenue for Console Connect. I think Megaport is trading at about 15 times trailing revenue at the moment. So the first question that always comes to my mind is who's right and who's wrong. My view, though, is that a rough back of the envelope calculation of Megaport's current market cap is that it's probably half what it should be, even at 15 times revenue. I mean, if Michael and the team at Megaport can continue to drive 35% revenue growth and 15% OPEX growth, then a rough NPV calculation suggests that the business is worth about $3 billion in 5 years' time. And therefore, the share price should be closer to 20. And at that market cap, Megaport is trading at 30 times trailing revenue. And so it's simple maths, but the numbers at Megaport are starting to prove that is the equation. And so my view is that Infratel got the bargain of the century buying the Console Connect network for 5 times revenue. I mean, Console Connect is equivalent to Megaport in reach. It is the same type of product. So for us, we get the same features and functionality from both of those ecosystem partners. And so I think Infratel stole it, is my view. What I would like is to see every ASX company with port in the name valued at 30 times trailing revenue, because at that price, ActivePort shares would be $2. But that's not the case at the moment.
Understand. Thank you.
So, Peter, last one. Are there any other questions? If anyone's got any other questions, please either type into the chat or is everyone unmuted, Alan? Yes. Yeah. I guess while we're waiting for that, final one from me. You mentioned the sort of the pipeline of sales prospects, and the global telco industry is really embracing this product. And are there any other constraints, or is it really about installation capacity? What other constraints are there to get this product really rolled out quickly?
The constraints for us is resources to deploy. We really do have what looks like an endless stream of projects in front of us that we need to get our teeth into, but we don't have a team of 100 people yet, and I think that's what we need. So I don't see any significant competition on the horizon. I think for most vendors to catch up to where Mark's at with the product would take 2 or 3 years. And we run those calculations ourselves across other features that we want to add. Should we buy the features or should we build them ourselves? 9 times out of 10, building a new product like ActivePort is at least 2 years to get to version 1. We're at version 6.8. And so I don't think we're going to see anybody pop up on the radar that could eat into that current target addressable market fast enough to dent our revenue growth prospects. So for us, it's about scaling up the business, Alex. It's really about just executing well, getting from a deployment stance to a deployment and support stance. What we will see is that as we deploy more telcos, there's a lot of upfront project revenue we're booking at the moment, and we should see that level out into a good blend of one-off project revenue plus solid recurring revenue. And I think also when you try and value ActivePort, it's two businesses in one. Our Global Edge product is like a Megaport, but the ActivePort software is being used by telcos around the world to build their own equivalent of Megaport. So ActivePort has two revenue streams that in their own rights are substantial businesses. And I think in FY24, what we've got to do is prove those both. I think we've proven the software business. We've got to get the network as a service business on the rails and demonstrate the economics of that business as well. It should be somewhat similar to the economics of Console Connect and Megaport and the like, just without the OPEX, without the cost of running the physical network. So it should be possibly more profitable sooner.
Yeah, fantastic. Now we're getting quite a few questions now on the chat. So another one from Matt Lambie, I guess following up on the really interesting announcement the company made about 2 weeks ago, artificial intelligence on GPUs. How much more can you share around the developments in this space?
Well, you've got to distinguish between training a model and running a model. We don't do training. Our product is, and our GPU deployments are all at the edge, effectively in the telcos. And so for us, it's about operating the models. Those same GPUs we're using with Radiant Arc to deploy cloud gaming and various types of streaming services. And so they're general purpose GPUs that we can run a number of different, the telcos can run a number of different types of applications on, including AI. So I would point out that there is a big difference between the GPUs people read about that are being used to train ChatGPT and the millions of dollars being spent in that sector versus the revenue that we can generate from operating those models at the edge. But it's a market that's growing. Every telco that we deal with has a plan to deploy some form of AI solution on their network. And so we're working through a bunch of those projects at the moment, and we will know in FY24 what the revenue prospects are for that sector of the market.
How far away are you from signing up a customer in the AI GPU space?
Within months, I would say. The challenges with AI is everybody knows or thinks they need it, but what they need it for is still somewhat of a mystery for some of the clients. And so it's a little bit like the tail's wagging the dog. For us when we talk about having a customer running AI, to us, it's another application on the platform. And so from an orchestration perspective, it's a new revenue stream, but it's not a revenue stream that's likely to dominate our revenue opportunity. It's just another feature set within the product, and the licensing revenue for us is the same for an AI model as it would be for any other type of application running on our servers at the edge.
Okay, great, Matt. Thank you for those questions. Next question from John Burgess. Hello, John. Given the success of the software business, do you still see the need to own the MSP businesses?
We debate this quite a lot. If you'd asked me that question 2 months ago, I'd probably have a different answer. One of the things we have on the horizon at the moment is deployment of ActivePort to some of the larger customers in Australia. It's early conversations and planning around some of those projects, but what it will mean is a significant uptick in the need for technical expertise to deploy these projects in Sydney. We have a great team at Starboard in Sydney, and so it wouldn't make sense for us to exit a business that has all the people and expertise that we need, only to present ourselves with the problem of having to go out and employ a whole bunch of technical people. So the logical the logical strategy for us at the moment is to leverage the resources we have to ramp up the revenue. And if that revenue was coming from India, Asia, North America, South America, and Europe, and Africa, and not Australia, then the MSP's future within the ActivePort business would be different. But I don't think that's going to be the case in FY24. I think a lot of the interest we're seeing from the telco sector in Australia means that we just need more people in Australia in the short term, not less. And so at the moment, humans on the payroll at ActivePort, whether they're in the MSP business, the ISP business, or the software business, humans are a very valuable asset for us, and we need more of them, not less.
Cool. Thank you. Next question from Ankor Puri. Thank you, Ankor. With the telco install base and active customers through Radianarc, what is the percentage of customers that are potentially to be converted with ActivePort offerings and are actively reviewing ActivePort?
So the 65 telcos that we're working with, a large portion, the majority of those from Radianarc. In terms of conversion, well, they're all committed to have our product installed, and so 65 is a big number, considering the size of those telcos as well. These are significant projects. So I think it's not a question of how many will convert, it's a question of how quickly we convert them. I think that answers the question.
In the sense that you're uploading ActivePort software to drive the Radianarc offering.
Yes. So the sales process is telco customer commits to using the GPU platform from Radianarc. With that, they get the ActivePort software. ActivePort then applies that same software and installation to orchestration. Mm-hmm. And so there are two revenue streams from each telco. One is the revenue stream we obtain from licensing our product to the Radianarc side of the telco business, which is primarily the 5G, 4G networks. And then the other part of the revenue stream is coming from the enterprise side of the network, and that's all about orchestration. So when you look inside the ActivePort revenue stream, there are two distinct sources of revenue from each of those 65 telcos. One is from the 5G network or the 4G network side of the business, and the other is from the core enterprise orchestration side of the business. In terms of the conversion of the 65 into both revenue streams, I think the answer is probably 70 or 80%. So far, we haven't had a single one of those 65 telcos suggest that they don't want to do orchestration. I think in one of the earlier slides, when people talk about network as a service and what customers can get from products like Megaport, Console Connect, the telco industry recognizes that it has to be in that space. You know, when a telco used to take 2 months to deliver a service to a customer, through Megaport, Console Connect, and ActivePort, customers can do that themselves in minutes. And so if you're a legacy telco or an older telco operator and you're not thinking about how you automate and offer your services through the internet, through a portal so customers can self-provision, then you're obviously going to get left behind, because in the telco sector, people expect that level of service. People buy all of their compute cloud capability as a service. You go to AWS or Azure, log in, build a server and connect to it. People expect that same level of service and capability from the telcos. And so, if you think that all telcos want to build their own Megaport equivalent capability on their own network, if Megaport's the gold mine, then ActivePort's the shovel. These telcos are using the ActivePort product to build this automation and present it to their users under their own brand. So I haven't seen a telco yet that says they don't want to do that. So I think the conversion rate of those 65 telcos to orchestration customers will be substantial, if not 100%. And for the ones that don't, we're still generating license revenue from the GPU and edge orchestration, which is only getting stronger with the advent of AI.
Yeah. And a follow-up, thank you, Peter. And a follow-up from Ankor is, with that conversion factor, what is the revenue and EBITDA expectation from converting these telcos, presumably to the ActivePort offering?
Yeah, so the indication in FY23 is each telco generates $3 to $5 million in revenue over 3 years. Some telcos are paying a lot of that up front because it's software after all, and if you can pay for it today rather than piecemeal over time, if you have the CapEx, then it's a better investment. And we like that. The more telcos that pay for term licenses at the beginning is more working capital for us. But when we map out the blend of telcos that are paying predominantly upfront versus the ones that are paying progressively as an operating cost, we're currently looking at $3 to $5 million per telco as our target addressable market. That could increase, but that's what we're seeing on the ground at the moment. And in terms of margin, because again, it's software, if I look at our models suggest that we should be up in the gross profit of 85% through FY24 and FY25. And it really just comes down to how well the underlying recurring revenue scales, because the recurring revenue has got a much lower cost of delivery than the upfront license revenue.
Yeah. Okay. Thank you. And final one from John Burgess. What was the contribution from Radian Arc sales to ATV in FY23? It
was one of those. It was a third of the software revenue. There were 3 major customers that delivered the $8 odd million of revenue. So it was in that order. And again, that's where our $3 to $5 million of revenue per customer. Radian Arc is not a telco, but they have an excellent sales team facing the telco market. We have other Radian Arc type customers in the pipeline, but also a lot of telcos. And so we at the moment, we put Radian Arc in that same bucket of a major customer generating an element of revenue per year, and across those 3 major customers, plus the pipeline of major projects that we're almost ready to turn live, we're seeing that revenue number of about $3 million average in the first year per telco or per major customer.
Fantastic. Next question is from Jason Brooks. Hello, Jason. How long will it be before a second and third, etc., of the 27 telco customers begins paying revenue? Is it simply a matter of staffing to turn the revenue on?
So we're working with 5 actively at the moment, which are within 6 to 8 weeks of go live. So I think now they're not all going to send us a check for $3 million in 5 or 6 weeks. A lot of that will be recurring revenue that builds over time. What we are finding though is the telcos that we're engaged with are each week asking us for more and more capability. And so the short answer is that we have 3 live in FY23. We need to triple that in FY24. And other than just running out of time or not having enough people, there's no real barrier to us getting that done. We need to, what I'd like to see is that we can go from a 1.5% conversion rate of those 65 telcos to 15% conversion rate. And I think what we're seeing at the moment is we're getting better at it as we do more. And so that timeline from first conversation with the telco to monetization has gone from 6 months to 6 weeks. Maybe 6 weeks is optimistic. I can see Mark hiding under the desk. But you get the idea is that the first one of these telcos had never seen us before, had no reference sites, really had to take it on face value what we could achieve and then work with us to achieve that. Now we've got a bunch of references under our belt that it's easier and easier for the telcos to see what we do and what benefit we add to their networks. And so that whole cycle of conversation to cash has shrunk from 6 to 9 months to 6 to 9 weeks.
Follow-up question from Jason. Are you hopeful that the revenue growth trajectory will continue as it has so far in FY24? Can you speak to revenue growth aspirations for FY24 and presumably FY25?
Yep. So we know that we can ramp the revenue because we know the customers are there. We also know that we can only do so many things at once, and so it's going to come down to a function of how many people we can afford to employ and how quickly. So I have no issue with the revenue ramping. The revenue mix might change, and so one thing I am at pains to point to people is, even though the graph is going up, if you break it down into months, it's still quite sawtoothed, because there have been some large cash payments made. And so reconciling our revenue number with our cash flow number in the 4C, and then breaking it down on a monthly basis, means that there's some fluctuation. So we could have some dips and valleys, but I think overall we should be able to draw an exponential line through FY22, 23 and 24 when we're done with the next year. What we will see, though, is that if revenue is up or down in a particular quarter for software, what we might not have in a one-time payment in a month or a quarter, we're making up for in recurring revenue, because the customers aren't. It's not a case of whether the customers are starting or stopping. We've got too many customers. We have too many customers. So that's not the issue. It's just whether that revenue is coming to us in large chunks or whether it's just building as a recurring revenue base. And I think we're just going to continue to see both of those types of revenue come through.
So we can't pin you down on a number?
That would be a forecast, Alex, and that would I'd get a call 5 minutes later from a whole bunch of people.
We don't want to get you in trouble. We don't want to get you in trouble. I don't know what here from.
Look, I think we know that with the people we have, as long as they don't burn out, we can deliver more revenue next year than we did this year. I think if we miraculously had 10 more people on Mark's technical delivery team, we could double the revenue. Or maybe triple it. And I think also as we get more live telcos, the recurring revenue coming out of those telcos is significant. If I look at one large telco we're dealing with in India and another one that we're rolling out in Asia, both of those have started with core orchestration, and we know that number is about $3 million of revenue, which is fantastic. They're both now talking about edge, and the edge number is, as I said, 8 times bigger than the core number. So just from the existing customer base, even without turning new ones on, we expect there to be an uptick in revenue and good solid recurring revenue, because that edge market is very, very, very valuable. And because all of these telcos get our edge products built in when they deploy it. So they get SD-WAN and VPN and NFV and SIEM and SASE and all the things that a telco wants at the edge. They get that built into our product. They push that out to their customers as a default solution. And so we expect the take-up of that edge revenue to be significant. And it's not a lot more difficult for us to deliver that because it's already there when they decide to turn it on. So there's an argument to say that if we did nothing, if we deployed 3 more telcos and then sat still, we would still see a ratchet up in revenue in the next year, because they'll just broaden the deployment and the use of the features in the product set that we're putting on premise.
And I've got one here from Fletcher Kirby. Just in terms of speaking of revenue, just in terms of the software revenue, yeah, that's great. Very strong momentum there. In terms of the Global Edge product, that sort of second column in your business structure,
yep.
What's it going to take to really drive the growth in that? Because in the IPO, that was, the PCCW and the alliance there was kind of, an important feature of the IPO story, but clearly it's still there. You've got this product now. What's it going to take to really drive that, and how can that go viral and become a global standard for Edge? Yeah,
focus on marketing. I think when we started, Mark and I said, and Karen, back in those days, we said, well, where do we go? Do we do network as a service, retail? Do we do core orchestration with telco? Do we sell ActivePort to the MSP and ISP market? And what we discovered is that the telco market was large, hungry. There wasn't a lot of competition there, and the revenue per customer was $3 million. In the MSP market, we found that there was a lot of competition. The revenue per customer was $40,000. And in the network as a service market, where it's just an easier way to deliver what we were talking about to the MSPs. And so what we've really done, we didn't get the Global Edge product live after the IPO because we had our arms eaten off by the telco market, and it just made sense to focus the resources there. So now we've launched Global Edge. What it gives us is a way to deal with everything that's not a telco. And so when you look at the way we sell today, we focus most of our effort on the telco sector because it's so good to us. And everything else we're pushing into Global Edge, because Global Edge is one of those sorts of businesses like Megaport, Console Connect, all those network as a service businesses. Global Edge is a product that we can ratchet up in an orderly fashion. The customer needs that sort of edge to cloud connectivity. They go to the portal, log in. The feature set that's there is the feature set they buy. It's easy for us to scale it. It's easier for us to add new features, and it's easier to support. And so what we've really done with the business is split it into, instead of having 3 or 4 different focuses, just the 2, telco and Global Edge. So to Fletcher's point, what does it take to scale that up? It's a factor of, first of all, good marketing. And the second thing is good customer service. We don't want to try and boil the ocean and find that people have a bad experience. We want to make sure we ratchet that up progressively over the next quarter, so that by the time we really do start to get volume of customers in that portal, that we've got the process of supporting those customers down pat. So I think it'll go well. We know the market is huge. We know there's great opportunity there. We just don't want to rush into it and create more trouble than we need right now. So we're taking it slowly, and people will see in the next quarter we'll start to ramp up the revenue in the Global Edge product.
Okay. Conscious of the time, we're getting close to the 55-minute mark. There's no further questions on the chat. Can I suggest 2 things? Well, firstly, thank you, Peter, for your time, and also Mark Middleton for your time on the call. Can I suggest 2 things? One is, if anyone would like a recording of this session has been recorded. So if anyone wants to get a recording of it for their internal purposes or to think it through, happy to provide that. So just get in touch with Bridge Street Capital. And the other thing is, if anyone would like, a one-on-one session with the company or a live demonstration of the product, which has been effective in the past when we've done marketing for ActivePort, please let us know again through the Bridge Street representative, and we can certainly arrange that. So with that, if there's no, I don't think there's any further questions, and we are at the, as I said, the end of the hour. I think we can happily wrap it up.
Thank you.
Peter, any other final comments?
That's it for me.